Hey guys, welcome back. So I'm very excited as the data has just been released and I can now show you Ray Dalio's portfolio for 2021. And there has been some pretty big surprises. First, a quick introduction for anyone who doesn't know who Ray Dalio is. Ray Dalio is one of the world's greatest investors, and he's probably best known for building the world's largest hedge fund, Bridgewater Associates. With a net worth of around $18 billion, amazingly, he is that good that when some of the central banks need advice with money, they call Ray Dalio. Please note, we only get access to the data for his stock portfolio. Unfortunately, we don't get things like bonds, commodities, property, cash, etc. And these are also just the US holdings also. So just bear that in mind. As always, if you do find anything useful in the video, be sure to drop a like, as that would be very much appreciated. Okay, sit back and relax, guys. Here is Ray Dalio's portfolio for 2021. Enjoy. Okay, so here is what we've got coming up. We're first going to take a look at Ray Dalio's portfolio for 2021. We're then going to take a look at the biggest changes that have been made. And a lot of times this is even more important as you get to see what the smart money is doing. We'll check out his biggest buys and his biggest sells. What's really good is that we do have performance data on this portfolio. So I'll show you how it's been performing and also how it's done against the S&P 500. And then we'll finish with a bonus clip of Ray Dalio explaining his holy grail, which is all about how to maximize performance and lower volatility using diversification. And he said on diversification, the problem is every single asset class that you love will have a day where it drops from 50 to 70%. If it's later in life, you won't have time to make up for it. Okay, so drum roll please. This is what the world's largest hedge fund looks like. The Ray Dalio portfolio of 2021. As you can see, this is a huge portfolio. Current value is around $11.5 billion, and it's made up of 427 different positions. So as you can see, we've got the larger positions before it goes into the smaller positions, and then there are loads of these micro positions. Now, even just trying to bring a list of these companies on the computer, it was crashing the Mac as there was just so many. So what I'll do, I'm a big fan of the Pareto principle and the 80-20 rule. So I'll spend more time focusing on these bigger positions and less time on these micro positions. Because even if one of these companies here triples, it wouldn't make any difference to the portfolio. So what I'll do is group together everything that has less than 1%. And this is what we end up with. So now we've still got the bigger positions, the smaller positions, and everything else has been grouped together. And now we have a very good selection of ETFs, individual stocks, and we get to see where these teams of analysts are putting their money. So let's take a look. So still the largest, biggest slice is the S&P 500 ETF SPY. Number 2 is the Vanguard Emerging Markets ETF. We then have the Gold Trust ETF GLD. We then have some individual positions. We have Walmart, Procter & Gamble, Alibaba. We have another emerging markets ETF, another S&P 500 ETF, another gold ETF, then have an individual Chinese company, Pinduoduo, more individual positions with Coca-Cola, Johnson & Johnson, PepsiCo, another emerging markets ETF, then Costco, McDonald's. We then have a China-based large cap ETF, a couple of developed markets ETFs, one slice in a corporate bond ETF, JD.com, a developed markets ETF, another China ETF, and the final single position is Starbucks. So there's some really good ETFs and companies to take a look at. What I've now done is just taken what the top 6 positions look like. And once I'd done this, I actually thought this looked like a very good beginner stock portfolio. as just by using the 6 biggest positions, you'd have 30% in an S&P 500 ETF. This is SPY, but it could be VU. A nice almost 20% in the emerging markets. You've got 14% in gold, some great single positions, Walmart, which is probably Amazon's biggest competitor, PG, and Alibaba, which is such a strong company. So even if you just took the top 6 positions, this would be a great stock portfolio. Find the most believable people possible who disagree with you, and then try to understand their reasoning. Moving on to the biggest changes that were made to bring this portfolio into 2021. This could also be thought of as where the smart money is moving. We'll look at the biggest buys and the biggest sells. So for me, these were the 3 biggest changes. The first was the number 1 position that is held, which was the S&P 500 ETF. There was a 7% reduction. But because this is the biggest holding, this is a massive reduction in US-based stocks. Number 2, a 45% reduction in gold. So my prediction is that you're probably going to start seeing a lot of headlines over the next couple of weeks that Ray Dalio is selling gold. Because normally Ray is a big fan of gold, so a 45% reduction is a huge move. And number 3, there was a 70% increase in one of his top emerging market ETFs. And if you recall, he actually had 3 different emerging market ETFs. So again, this says to me that money is flowing out of US stocks and into the emerging markets. And then the other thing which really surprised me is that he doubled up on a lot of his individual stock positions. So these aren't 5 or 10% increases. This is literally over 100% increases in these individual stocks. So maybe good for you guys to check out. And these were Procter & Gamble, Walmart, Coke, Johnson & Johnson, McDonald's, Pepsi, and Costco. Okay, so the great thing is that we have some performance data on this portfolio. First up, what are we looking at? So this is a quarterly chart, and it goes back to the beginning of 2019. So what does this tell us? Well, the portfolio peaked out at the beginning of 2019 over $15 billion. You can see 2019 was a really bad year for this portfolio as it was declining quarter on quarter. In fact, it declined all the way down to 10 billion. Then Q1 2020 was an epic drop from 10 billion down to 5 billion. And I ask, how many of you could stomach a $5 billion loss in just 1 quarter? And in fact, this is a 50% reduction. The rest of 2020, though, was pretty good, and every quarter was building on the last. And this was the quarter that brings us up into 2021, now over $10 billion. Next up, we have data against the S&P 500. So what are we looking at? This is a 5-year chart, and the bottom purple line is the S&P 500, and the top blue line is Ray Dalio's portfolio. But just now it's the top 100 holdings, so not all 400. But as you can see, they were pretty closely correlated for quite a long time. Then it was around April 2019, they started to diverge, and more recently, Bridgewater Associates is comfortably outperforming the S&P 500. 5-year performance is 190% versus the S&P at 102%. So good to see they're outperforming the S&P 500. If you're not failing, you're not pushing your limits. And if you're not pushing your limits, you're not maximizing your potential. Okay, so to finish, I have a bonus clip for you guys, and it's Ray Dalio talking through his holy grail. And this is how to maximize performance and lower your risk using diversification.
The real question for me was, what were the marginal benefits of diversification like? What is that going to look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return asset, return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation, or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows, okay? And it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good, uncorrelated return streams. Things that are probably going to make money, but you don't know, but have a good probability of making money, and that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you can do is find the best investments. Okay? That's important, okay, but there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5, right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that path. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%. Okay, as distinct from 40% with any one of us. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
So there you are, guys. That was the 2021 stock portfolio from one of my favorite investors, Ray Dalio. And as you saw, some very interesting insights. Firstly, good to see that they're still outperforming the S&P 500. Interesting to see such a large reduction in gold. They have been building much stronger positions in individual stocks and also continuing to build up in emerging markets. So I hope you found this useful. In fact, just one favor to ask. If you did find anything useful in the video, be sure to drop a like. Only takes 2 seconds and it would be very much appreciated. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching and I'll see you in the next video. Bye for now.